The best stock screeners for finding your next big trade are not the ones with the most filters, the fanciest interfaces, or the longest lists of indicators. They are the ones that force you to think clearly about what kind of opportunity you are actually looking for and prevent you from confusing activity with progress. I've watched traders over the years obsess over screeners as if the right settings would magically surface profits, when in reality, a screener is nothing more than a flashlight. It only helps if you already know where to point it, and if you don't, it will just illuminate noise faster. Early in my career, especially during the dot-com era, I treated stock screeners like slot machines. I ran dozens of scans every day chasing unusual volume gap-ups, breakout patterns, anything that looked exciting. I felt productive. I felt engaged. What I didn't feel was consistent profitability. The screeners weren't the problem. My lack of intention was. I was asking the market random questions and hoping one of the answers would make me money. Over time, I learned that the quality of the question matters far more than the tool providing the answer. The first principle you need to understand is this. A stock screener does not find trades, it finds candidates. The decision-making still belongs to you. If you expect a screener to replace analysis judgment and risk management, it will betray you quickly. Used correctly, a screener narrows your universe so that your brain can work on fewer higher-quality problems. Used incorrectly, it overwhelms you with possibilities and trains impulsive behavior. There are 3 broad categories of screeners, and understanding which category fits your style is far more important than brand names. The first category is fundamental screeners, designed to surface businesses that meet certain financial criteria: revenue, growth, profitability, cash flow, balance sheet, strength, valuation. These are the tools value investors and long-term traders lean on. The second category is technical screeners, which scan for price-based behavior, like breakouts, moving average alignment, volatility, contraction, or momentum shifts. These are popular with swing traders and short-term traders. The third category is event-driven, or relative activity screeners, unusual volume, gaps, earnings, reactions, sector strength, which are often used by day traders. Most traders fail not because they use the wrong screener, but because they mix these categories without realizing it and end up trading against their own time frame. For long-term investors, the best screeners are boring by design. Tools like FinViz Yahoo Finance or even basic brokerage screeners are more than sufficient. What matters is the ability to filter for consistent revenue, strong margins, manageable debt, and reasonable valuation relative to history. The mistake beginners make is adding too many criteria at once, trying to engineer the perfect company. Perfection does not exist. A good fundamental screener should reduce your universe to a manageable list that you then analyze manually. If your screener outputs 1 stock, you are overfitting. If it outputs 500, it is useless. For swing traders, technical screeners become more relevant, but they are also more dangerous. Scanning for breakouts momentum or moving average crosses can surface opportunity, but it also surfaces traps. In strong bull markets, these scans work well and condition traders to trust them blindly. In choppy or transitional markets, they produce false signals in bulk. I learned to treat technical screeners as alerts, not triggers. They tell me where to look, not what to trade. The best technical screeners are the ones that align with a single well-defined setup you already understand deeply, not a collection of patterns you vaguely recognize. Day traders rely heavily on relative activity screeners, but this is where discipline must be highest. Unusual volume gappers and news-driven movers attract crowds. Screeners here are not finding inefficiency, they are showing you where attention already is. That can be useful, but it also means competition is fierce, and mistakes are punished instantly. I've seen traders blow up, not because their screener was wrong, but because it delivered too many opportunities too quickly, and they lacked the filters to say no. Over the years, I noticed that the most effective traders I knew used fewer screeners, not more. Often just 1 or 2 scans run at specific times of day, tied to a specific strategy. They did not refresh them constantly. They did not chase every result. They treated screeners like scheduled research, not entertainment. That discipline mattered more than the platform itself. As for specific platforms, each has strengths and weaknesses, but none are magic. FinViz is excellent for quick visual fundamental and technical screening, but it can encourage superficial analysis if you don't slow down. TradingView offers extremely flexible screeners, but that flexibility can turn into overcomplexity if you keep adding filters without clarity. Thinkorswim and Interactive Brokers offer powerful built-in scanners, but they assume you already know exactly what you're looking for. The tool is never the edge. The edge is knowing why you are scanning in the first place. The most important upgrade I ever made in using stock screeners was shifting from asking what looks good today to asking what fits my plan right now. If the market was trending cleanly, I ran trend-aligned scans. If the market was choppy, I ran no scans at all. If volatility was extreme, I narrowed criteria aggressively or stepped aside. Screeners became servants of context instead of drivers of action. And this is where the conversation needs to continue next, because knowing which screeners exist is far less important than knowing how to design a screener that matches your strategy, how to avoid common screener traps, like overfitting and recency bias, and how to integrate screening into a daily or weekly routine without turning it into a source of impulsive trades. And that transition from overview into practical construction is exactly where we go next. As this sentence carries forward into how to build simple, robust stock screening rules for different trading styles and how to use them calmly and consistently, instead of chasing the illusion that the next big trade is hiding one refresh away. And that is where we continue next, by designing your screener from the strategy backward, not from curiosity forward, because the fastest way to misuse a screener is to let it decide what you trade, instead of letting your plan decide what the screener is allowed to show you. The first step is brutally simple and almost always skipped. You write down in plain language what a good trade looks like for you. Not the pattern name, not the indicator, but the condition. For example, a strong stock in a strong market pulling back quietly to support, or a fundamentally solid company trading at a discount after temporary bad news, or high relative strength names consolidating before continuation. If you cannot describe this without a chart, you are not ready to screen for it. Once that description is clear, the screener's job becomes narrow. You are not trying to find the trade, you are trying to eliminate everything that does not fit. For a trend continuation swing trader, this might mean filtering for stocks above a rising 50 or 200-day moving average with relative strength versus the index and average volume above a minimum threshold. That's it. No RSI tricks, no max D crosses. The screener finds strength and liquidity. Your eyes and judgment decide structure and entry. If your scan returns dozens of names, that's fine. You are looking for candidates, not answers. For a value-oriented trader or investor, the screener should feel almost disappointingly boring. Revenue stability over multiple years, positive free cash flow, reasonable debt levels, and valuation metrics that are below the company's own historical norms, or peers. You are not screening for upside. You are screening for survivability and mispricing. If your value screener surfaces companies that feel uncomfortable or ignored, that is usually a good sign. If it surfaces only popular names, your filters are probably too loose or too trendy. For breakout traders, discipline matters even more. A common mistake is scanning only for new highs or large percentage moves, which simply shows you where excitement already is. A better approach is screening for preconditions, tight ranges, declining volatility, compression near resistance, and rising volume potential, not volume spikes already happening. The screener's job here is to identify setups in formation, not moves already in progress. If you are always late, your screener is asking the wrong question. Day traders must be the most careful of all. Event-driven screeners show where attention is concentrated, not where edge exists. The screener must be paired with strict rules around liquidity, spread float, and time of day. Just because something is moving does not mean it is tradable for you. Many day traders blow up not because they lack opportunity, but because their screener delivers too much too fast, and they lack the filters to say no. In fast markets, fewer names and stricter criteria outperform constant scanning. One of the most important rules I follow is no mid-session screener modification. If you change filters while trading is live, you are responding emotionally. All screener changes happen during review, never during execution. This prevents the subtle habit of optimizing scans to justify a trade you already want to take. Screeners should feel static during the session and flexible only during structured review. Another critical safeguard is time boxing your screening. Run scans at specific times, pre-market end of day, or weekly, depending on your style. Do not refresh endlessly. Endless scanning trains dopamine-driven behavior and creates the illusion that opportunity is scarce and urgent. Opportunity is not scarce. Your attention is. Protect it. Overfitting is the silent killer of screener effectiveness. If your screener produces perfect results in backtests, but nothing usable in live markets, it is too specific. Markets change. Your screener must be robust enough to work across environments, not just the last 3 months. Fewer filters applied consistently outperform complex screens that require constant tweaking. The final and most overlooked step is post-scan accountability. After a week or month, review what your screener produced. How many candidates turned into valid trades? How many were ignored? How many were forced? This feedback loop tells you whether the screener is aligned with your strategy or just generating noise. Screeners improve through subtraction, not addition. Looking back, the moment screeners became truly useful for me was the moment I stopped treating them as idea generators and started treating them as gatekeepers. They kept bad trades away from my attention so that my best decisions had room to breathe. That is their highest function. If this framework helped clarify how to actually use stock screeners without overtrading or chasing, I invite you to subscribe to the channel so we can keep refining process over impulse, and leave a comment sharing which type of screener you rely on most and where it tends to lead you astray, because awareness of that pattern is often the difference between a tool that drains you and one that quietly supports consistency over the long run.